Good afternoon, ladies and gentlemen, and welcome to this afternoon's panel on value investing. Is the turning point coming? My name is Stephan Meier. I'm the CEO of OpenFunds. We're a distributor for a range of foreign funds here in Switzerland. And let me start by introducing the panel to you. To my far right is Christophe Braun, equity investor at the Capital Group, with responsibility for the equity strategies. He has 11 years of investment industry experience and has been with the Capital Group for 5 years. Then on second from the right is Bruno Springael. He's a portfolio manager at NN Investment Partners, co-manages the global dividend value strategy for American Century Investments, and is also the portfolio manager for a sub-advised portfolio for NN Investment Partners, the global high dividend fund. Then next is Georg von Wyss. He's a partner at BMW Value Investing and a portfolio manager of the Classic Fund. He co-founded BMW in 1997 and has built a reputation as a value investor here in Switzerland. And last but not least, Jeff Atherton to my right. He's the head of Japanese equities at Man GLG. He joined the Japan Core Alpha team in March 2011 and took over as lead portfolio manager in 2021. He has over 30 years of experience investing in Japanese equities. To set the stage for value investing, I think the first question that I want to ask all of the panelists in turn is actually, what is value for you? What do you consider when you say, I'm a value investor? What is it that you look at? And how do you present value strategy to your clients? Maybe if, Christophe, do you want to kick it off?
Sure. Well, thank you very much again for having me here today. First of all, I think value is more than just a style. And I think we forget about this very quickly when we enter into those growth versus value discussions. I think it's much more complex. A company has substance, but that substance would evolve over time, and so does the definition of value. So often when I think about value, it can be a misrepresented or a mispriced asset within a company, sort of a hidden asset. Then I would call about it being inexpensive as a value company, but it can also be cheap when there's a lot of leverage, financial leverage. Then value becomes cheap for me very quickly. I think there's a lot of ratios. Obviously, I think we can mention them. There's ratios you can look at. Price to book was a ratio that we discussed earlier, which sort of has disappeared more recently. But then I think in an inflationary environment, when I look at value companies, it's pricing power. So how much pricing power does a company have when raw material prices are going up, for example, and how resilient are those margins, profit margins that companies have today to protect their business and forward those prices to their customers. So that's what I call resilient value. Obviously, I think dividends will also be mentioned at some point, which is another characteristic when we talk about value.
Okay, I think that's quite a broad array. Maybe, Bruno, what's value for you?
Yeah, thank you. First of all, what I would like to stress is that before talking about value or valuation metrics or accounting, the first thing we are trying to do is to understand the true economic reality behind a ratio, behind the valuation metric or any possible value indicator. What we do then at American Century Investments is to start with doing an in-depth analysis of the normalized financial productivity of any asset we contemplate to put in a portfolio, and we do that two ways: normalized in a going concern, in a business as usual, and also where we end up in a downside scenario. from there, you start to look at something that is more value related, I would say, in the sense that you need to use tools to do that. What we do is to use forward-looking returns on capital. We extrapolate that to a normal and non-downside valuation. And then you end up with the metrics, of course. The metrics we end up with, and our key metrics to do that are EV to EBITDA, unlevered free cash flow yield, forward PE, and dividend yield. So I hope that answers the question with a number of classical valuation metrics that we might compare between the different panelists.
Mm-hmm. Maybe next to Georg von Wyss.
Sure. At BVM, we define value investing as trying to buy things at a discount. So the question first is, what's the asset worth? And there we're not very different from what you do. We try to figure out what the company earns on a normalized basis, what's the normalized cash flows. To do that, you have to understand its past, that you try to make some assumptions about where it's going. And then you try to figure out what would well-informed business people pay for that asset. If we were rich enough, all of us in this room, to buy Microsoft, what would we pay for it? And then once we get a number that seems about right, that if basically the value that two well-informed people would agree on, one the buyer, one the seller, then value investing for us means buying that thing at a big discount. We're looking for about a 40% discount on the things we're buying. That's why you can buy the sausages at our stand for 60 centimes for a franc's worth of sausage. That's what we're trying to go for. And the key to value investing for us is being conservative on the assumptions about what's going to make the asset, what makes up the value of the asset, and then insisting on that discount. And the way to get to the estimate of the intrinsic value is to apply all the tools at our disposal as securities analysts, all the various multiples, DCF, blah, blah, all those things. Those have to tell the same story, otherwise you've missed part of it. But we're not focused on any one ratio. Okay, and last but not least, Jeff.
Thank you. It's actually good to see so many faces in the audience. I think 2 years ago it would have been a lot emptier. Value seminar. We've been doing this for quite a long time at GLG. I mean, I've been involved with this process for just over 20 years, and it's very much a pure value type of strategy in the sense that we don't really blend it with anything else, and it either works or it doesn't. And it's tended to work more often than not in Japan, which I think Japan's quite a good market for value, which I can go into later. But we're looking at two things, really. One is contrarianism, and we only want to buy things that have been out of favour as defined by price performance. So typically we're looking at stocks that have underperformed the market by 30-40% over a kind of 4 to 8 year period. That's a sort of sweet spot that we find. So it's very much trying to find names that are out of favour, that are unfashionable, depressed for whatever reason, and can they get back, and can they mean revert somewhere to where they came from, and if they can, you'll make some money. And our definition of value is really relative, I think. We're looking at the value of that company relative to its own history and relative to the stock market. So the fact that it's absolutely cheap may not be enough, and is not enough frequently. So we want to buy things that are at a discount to their normal history. And we're looking at things, price to book was mentioned. We used to look at price to book a lot. We have moved away from that a little bit. Even in Japan it's less reliable, but I think price to sales is a good one. EV to EBITDA, some of the parts, etc., even a normalized PE. But you know, can the business get back to where it came from? And the share price will follow suit, and you can make a lot of money on that basis. So it's relative value, but it's also very much tied in with contrarianism.
Maybe I can pick up on two of those terms, the contrarian and this margin of safety. Is that so if you wait for something to become 40% below its intrinsic value, that must assume that markets are pretty inefficient. Is that really your view, that markets are so inefficient that something can be 40% cheaper than it's actually worth?
Well, what we're looking at is it was worth 40% more 5 years previously. So we're not looking at trying to reach the sky where it's never got there before. It has been there. So what enabled it to get there, and is there a realistic chance that it can get back somewhere close to that. I mean, we don't need to get back to that high, obviously, but that's where it's come down from. So yes, the answers are the market is very inefficient. I mean, you just have to look at the price performance of things like Peloton and Zoom or anything else at the moment to show you that the market really is not very efficient, and greed and fear remains, as it has been for 150 years plus, very important mechanism to exploit, and I think that's as valid today as it ever has been. So yes, the market can be surprisingly inefficient.
But I think there's also a difference. I mean, you mentioned Peloton, that these are stocks that are sometimes overvalued, right? That's the inefficiency. But when I look at Japan, for example, there is an inefficiency in terms of informations that are available. So if you look at Japan after 20-year bear market, there's very little sell side or brokerage information available on companies, small, mid-cap companies that we all outside of Japan don't know. So, and that's where you can have that margin of safety much more easily than, for example, in a market that is much more commercial, that's much more known, the US, Europe, for example. So I think from Jeff's perspective in Japan, you can find those, if you have boots on the ground, if you speak the language, you can find names, especially in Japan now with the tech revolution taking place after COVID. There's a lot of small and mid-cap companies in Japan that don't even feature in the index. So of course, the margin of safety here, the upside is much, much bigger than if you buy an S&P 500 or Russell company.
I think for someone like us that has a portfolio that's very concentrated and that we can also afford to invest in small caps, it's possible to find 25 or 30 names that are very undervalued according to, based on the criteria that we're looking for, because the markets can be very inefficient, as Jeff said. But of course, for value investing to work, they have to be pretty efficient most of the time. Otherwise, things won't go up to their intrinsic value ever. So we're looking for those exceptions where the market has mispriced something to the downside. We can't go short the overpriced stuff, so we don't. But so we're looking for those few exceptions where the intrinsic value is much higher than the stock price, in the expectation that other people say, hey, hang on, that's wrong. Let's buy this thing while it's cheap and it'll go up. And that's where we should make the money. And of course, one of the reasons the style hasn't worked is that mechanism hasn't worked, and so people have avoided it. Instead, they just buy Apple and Microsoft and Tesla because that's easy money, or it was until recently. And they don't pick through some of these smaller things, these weirder things. They don't do the work. Sometimes there's no coverage, and as a result, we've seen intrinsic values go up, which means we're buying cheaper things. We're buying cheap things, but the stock prices don't move. So the discount gets bigger and bigger on the funds.
Bruno,
we don't use the margin of safety in the sense of it was used in the 90s, primarily for two reasons. One, that for instance, these days it's an extremely difficult to apply concept when the markets overall can be qualified as overvalued, meaning you hardly find anything with a margin of safety. And the second thing is that the margin of safety concept in the traditional sense only takes the upside into account. Yeah. And has no kind of sense of what could happen to a firm on the downside. So what we prefer to do is to apply a slightly different methodology where you take into account and the upside relative and the downside, and to find the right equilibrium between that upside and downside to have also exposure to those reversals that are referred to, but to be honest, you by looking at both, you end up in a situation where you prefer to have more consistent and more regular reversals, even if a little bit less obvious than the 30 or 40% upside that was referred to.
Maybe if we can stay on the topic of the downside, I think one of the criticisms of value investing is that if you have this strong focus on this big margin of safety, that it automatically drives you into some value traps. So something is cheap for a reason. It's suddenly trades at half times book or at a PE of 6, but there is a good reason why it's down there. So how do you manage that? I think that must be one of the problems you face constantly when you're a value investor.
I mean, for us in particular, as contrarians, that's the key point really, because if you're buying things that are down, there's some sort of initial reason why that's the case. So you have to be very careful. But I mean, we the answer to that is really good old-fashioned research is the way to beat this. And you've got to be very careful about what you buy. I mean, we would also point out that there's an awful lot of growth traps out there. I think anybody that's been invested in Facebook in the last year might be, feeling that there's something of a value trap about that. So it can hit everybody. And I think one of the key points for me really is the last few years that we've been getting this message out is that price disappeared from the investment process, and at some point, and I think it's coming back quite rapidly now. And that's I think the key point. You can get a value trap or a growth trap anywhere, but if you buy something low enough, you've got a really good fighting chance, I think, of making money. And there was a famous comment from, I think it was Scott McNeely at Sun Microsystems in the late 90s saying that anybody was crazy to pay 10 times sales for a business, and gave a long reason why this was the case. I mean, if you look at Japan's growth names, I mean, Keyence is probably the finest company in Japan, which I've been following for 30 years. It's a fantastic business. It's normally on 6 to 12 times sales. It peaked at about 30 times sales last year, and it's about 22 times sales now. That's very, very high. And, the margin of error on that one is extremely low. So I think there's a whole generation of fund managers who've just forgotten that price is very much part of what you're buying. And if you're buying a nice house or a nice car, you surely look at the reference price to what other people have paid for it before you decide. And I think that's the key point. So yes, value traps are always a danger for anybody, I think, but really, if it comes back to price, and I think it is coming back to price in the markets, then, value ought to win.
I think there's also a risk that you generalize too much, a value trap, in which sector, in which region. If you buy overval communism in emerging markets, you always have this political risk, this downside risk when you invest in emerging markets. So the value trap, or even that margin of safety, has to be bigger, because otherwise you can very quickly fall into a value trap. But if you invest in Europe or in Japan and US, it might be different. So I think generalizing based on sectors or regions is also very, very difficult and can be dangerous.
For me, a trap is what you said, Jeff. It's when a company doesn't develop the way you think it would. So it doesn't really matter whether you call it value or growth to start with. And so it's like you say, it's all about the research. You want to make sure that you don't buy too many things that develop poorly. And if they do, then the margin of safety helps you against taking a loss on that position. Remember, you're paid less than the intrinsic value of the business, so if it turns out you were wrong on the intrinsic value, hopefully the stock price hasn't moved, but of course it hasn't. A lot of times that happens. But the point is to do the research and try to focus on cases where you think you have a reasonably good chance of predicting the business's future. And I think one thing that hopefully or supposed to distinguish value investors is we're a little bit more careful about valuing future businesses, about evaluating their future prospects. And we're a little bit more conservative about how much good stuff we ascribe to the intrinsic value, and maybe a little more cautious on our assumptions as to its future growth or future margins or all those kinds of things.
Yes, you can. I think you can also do that by defining your investment universe, and that's frankly the way we tend to do it. Before starting the research, you already make sure that you look at companies that are sustainable and predictable returns, so that you have a reasonably narrow range of outcomes. You try to avoid those that are too leveraged, for instance, and if you do that, you're already implicitly building that margin of safety, because you will probably avoid the worst value traps. That's the way we tend to do it. So by already defining your investment universe in a sense that you will avoid the worst torpedoes that you may encounter in your asset pool.
I have a question. Do you also, in that sense, include dividend payout ratios into your margin of safety? Is that something you take as a cushion?
That is, we look at dividend, but that's not the key thing we look at.
Okay.
Yeah, we don't pay attention to those. We pay attention to the cash flows, but not whether they pay them out.
Yeah, but to be complete on that, that's also because for part we are running dividend funds, so we have to look at dividends also. But indeed, the cash flow thing is broken.
And one thing we try to do to improve our investment process, we've been working on a little bit, is trying to price options in the business. So let's say you have a company that's got a new product that they're developing, and they think it's going to be a wonderful thing. And they tell you, of course, that it will be. And so if you get enough information that you can say, well, maybe if it works, it'll add this much value. If it doesn't work, it doesn't, or whatever. But you want to try to include that sort of contingency in the analysis. Gives you a range of values. Now, we always talk about the intrinsic value, and of course, you have to have one number for a bunch of reasons. In the end, it makes life easier. But the reality is, of course, you want to see all of the possible outcomes around that number, and that could include bad things happening too, of course. The options are the good things, but you can also have negative stuff that hits the valuation, like you were saying, Bruno. And you want to reflect all that. And of course, the ideal portfolio is the one where no matter how many bad things happen to the businesses, you're still going to make money. We're still looking for that portfolio.
I mean, the one thing, obviously, that attracts people to equity investing are the Amazon and Microsoft and Tesla stories of this world, that you sit in something and then it just goes 100x or something. Can you, with your process, be in such a stock for a long time, or is there something inherent in a value strategy that will take you out of these companies, or will never get you in the first place?
I'd buy Tesla at 50.
I think you can make. I mean, we made a lot of money out of Sony, which
was
was
their business, it's their valuation that matters.
We back at the end of 2012, we were the biggest investor in the world in Sony, and that's at a time when it was really written off and it was struggling against Samsung and Apple. And people thought that they just couldn't compete, and it was a sort of classic value trap, and it turned out to be a fantastic opportunity. I think the share price has gone up 10 times. Now, the answer to your question is partly that we get off long before it goes up 10 times, so we miss on something. But, I think that was a great sort of kind of moral victory for us, that a company like Sony, which is very well known and was completely written off, actually has come roaring back and done extremely well. So, yes, at the right price. And the other thing I noticed that, certainly in Japan, is that the market really overemphasizes or gets too hooked up on a structural something, and quite often it's a cyclical something. So we find that more things are cyclical than the market thinks, and that less things are structural. And there's, at the moment, obviously tech, people think is a structural win, but tech has historically been cyclical. At previous times in the early 2000s, anything to do with China in Japan was being very, very highly rated because China was coming onto the global market. So if you were selling steels, petrochemicals, anything, you were doing fantastically well, or even like a Rio Tinto type name. And then, of course, that all sort of hit the dirt. And more often than you think, I think things are cyclical and not structural, and that plays both ways. And I think value investing is probably better placed to exploit that. And what's happened recently is that the cyclicality has been less prevalent, and there's been some longer running trends. But when they break, I think that will come back to the forefront.
I just want to mention this is an open forum, so if you have questions for the panelists, raise your hand, and then I'm happy to. There's one right there in the back.
Okay, I have a small question to all of you sitting in front of us. Since a few months, we have suddenly the problem, a little bit of inflation. And inflation doesn't affect the past values, but it can inflect the future values. You mentioned the word pricing power is important. how do you deal as value investors with the problem of inflation?
Shall I go first? So first of all, and that doesn't only include looking at companies in sort of the value spectrum. I think even growth companies, which I very often describe as the new defensives, because they have not, the .com companies, but I'm talking about growth companies, tech companies today. They have positive, stable free cash flows. They have solid balance sheets. They have a very recurrent business. And that helps them with their services. So strong brand, we talked about pricing power. They are becoming more and more household names that are very difficult to live without. And so I think that makes those companies in an inflationary environment, a local name Nestle, for example, very resilient in high inflationary environments, because what they basically do is they take the price increases and they forward them to their customers, because it's very difficult to get around those multinational names. If you don't like this product because it's too expensive as a customer, you might choose another one, but guess what? That might also be owned by the same company. I think with what we've seen, if I look just away from the value and I go into the growth area of the market, of the investment universe, and you look at semiconductor companies, they have increased their semiconductor prices, microchip prices over the last 2 years by, on average, 10 to 15%, because there's huge demand, very little supply, and you can see that across staples as well. You can see that in other areas where those companies are exploring and benefiting from high inflation. So I'm actually seeing a lot of problems, structural problems for the old economy companies to fight against inflation, and I see much more benefits for those more growthy companies today, because they are becoming, as I said, household names, and it's very difficult to get around those companies. My angle.
Yeah,
my
I'm going to
opinion.
disagree with you.
Well, fair enough.
As I do as well.
As value investors, you have to, but
No, it's to answer your question. It comes down to trying to figure out where the company, how the company's business is. Do they have pricing power? Can they pass on? How fast can they pass on prices? For example, to take Nestle, they probably can't pass on prices as fast as their costs are going up, because they have to renegotiate their contracts with the grocers, and so you're going to get a little bit of a squeeze, and then the question becomes, can they rebuild that margin over time? That's what, then, when we're not here, that's what we're doing at the office. These kinds of thinking about that and I wouldn't necessarily say that every business is going to have a, that there's not categories of businesses where you can say they have pricing power and they don't, like old economy or new economy or like that. It really depends on the industry structure.
It's company specific. Even.
Yeah, it's always company.
I agree.
It's all about market structure. It's all about how much competition there is. It's all about good substitution, all the stuff we learned in microeconomics, and marketing. So those are the kinds of, that's what you then do. And then if you take a company like Nestle, which I liked as an example in Switzerland to get people's attention and to really make them hate us, because what I say about Nestle is it's a wonderful company. They probably have pricing power, like you say, but rising interest rates, which are going to come with inflation, are going to take that PE multiple down a lot, and for two reasons. Number one, mechanically, you're going to be valuing those cash flows at a higher discount rate, and that affects you more if your PE is higher. We did a lot of work on that. It's all on our blog. You're going to have a big impact, so no matter how well the company does, its valuation is going to suffer more than a company with a PE, say, of 10. And so the second impact was what? I forgot. Help me. It's the discount rate. That's the big part of it. So, and I like to point that out to say, guys, if you own Nestle, careful. It's a great company.
Yeah.
Everything right, but it's going to get cheaper. And like, oh, no.
we shouldn't ask the wrong question. I mean, the question is not whether the company is a growth company or a value company. The question talking about Nestlé, you can have cheap growth companies, expensive growth companies, and the same is true in other sectors. So we should never forget valuation to that respect. I mean,
totally agree.
And indeed, another concept that we will have to learn again is discounting rates. Discounting rates. Bear in mind, value stocks are usually short duration assets. Mm-hmm. Growth stocks are usually long duration assets because those cash flows, those wonderful cash flows that we're talking about, will rather come in the future. Well, when inflation filters through the system, and normally as a result, rates start to go up, indeed the P in the PE equation starts to be hit big time. Much more that many people in the marketplace remember, actually. So I would be extremely careful, and accordingly Nestlé and many others are wonderful companies, very, very good. But there's a price to pay for everything.
I think that's important where you have to look at how sustainable, how resilient those earnings in the future are. Mm-hmm. If you can look into the future, make sure those earnings are actually more stable, the discount is less big than you might think.
I think looking into the future is always very dangerous. I mean, Unilever in the UK was a name that was thrown at us a few years ago as a sort of great example of a stable business. And that share price has had a shocker in the last 2 years on the back of things like rising raw material prices. So I think the future is not seeable a lot of the time. And I think pricing power is quite cyclical. Semis are doing very well now because it's a very tight demand supply, and that's the end of that. But if you want to see an industry that's got the most pricing power of anybody at the moment, look at container shipping. About as old as you can possibly get as a business, but everything is tight as a drum. So, I think a lot of things are cyclical. I think Unilever and Nestlé, I don't know Nestlé so well, but I know it's a similar business mix. But Unilever, for being a long time, I mean, I started my career looking at Unilever in the 1980s. It was on a PE of 10. And a yield of 4, and nobody liked it. And then over the next 25 years or so, it got heavily re-rated. So I kind of know that stock quite well. So when it was being pushed to me as a great stock at 25 times earnings and stable and guaranteed income and earnings, I just had to sort of smile. So yeah, I mean, inflation is very good for value if you look at performance of value stocks in the last 15 months, because inflation means bond yields go up and it crushes the PE ratios of growth companies. So bring on inflation, I think.
Yeah.
Sure.
I forgot. I remember what I was going to say. Is especially a company like Nestlé, which is obviously a household name around here, but I suppose Unilever in Britain or in the Netherlands or wherever. All the big dividend payers have become bond substitutes. A lot of people making no money on bonds were buying these stocks, saying, well, I'm getting a great dividend, and the stocks go up a lot more than my bonds ever did. This is terrific. And so I'm going to, since I can't reinvest the money that just came out of those bonds that matured, I'll buy Nestle stock instead. And what's happening now is, as these things derate, which they should, a lot of that re-rating you just mentioned in Unilever, you can see that in Nestle, and you can explain almost all of that re-rating with the decrease in interest rates. So the corollary of that is as interest rates go up on the PE. And so as people realize that, they'll go back to bonds because they're going to be returning more, and that's fine. That's where they probably should be if they're a bond investor by nature anyway. And at the same time, the expensive stocks will go out, and people say, golly, there's a lot of cheap stuff out there. Maybe we should buy some of that. That's when we get that rotation that we keep that's happening.
Maybe we should come back to the original question that maybe brought some of you into this room. Is the turning point coming? I mean, I want to put it in two segments. The first of all, why did value, in your view, underperform so badly over the last, 10 years? And why do you think that we are now at a turning point? You've already talked about the interest rates, but is that the only reason, or what else is there?
All right, I'll take it.
Well, first of all, deflationary environment, low interest rates that we've seen for 10 years, as Jeff mentioned. But then it's also a paradigm shift across sectors, across consumer behavior. If you look at some of the old economy value companies, energy, you look at tobacco, you look at telcos increasing capex to get ready for 5G. Tobacco, we know all the ESG story. Energy was under pressure until more recently with the energy price. So a lot of those so-called value sectors, they have had a really tough time. On the other side, we're seeing, and this is not just an outcome of COVID or lockdown, but I think the tech revolution has gained even more speed during COVID and lockdown. And so I think the way people, young people, old people consume today is much more is in a much more digital way, and I think that's giving a lot of those companies today in the more sort of core growth spectrum much more resilient earnings, as I was saying earlier. So I think it's a paradigm shift, but then also I think what it would need is higher interest rates at some point, more inflation for it to see a revival.
Do you agree with that?
Yeah. We don't go first.
I see three things that, in my view, warrant a paradigm shift in the market in terms of value growth. Two, we have already mentioned, inflation and rates. It can be a combination of both, even if inflation starts to stabilize. By virtue of real rates going up, you can still have a significant move in value in the value parts of the market. And there's one thing we forget to mention that's a little bit surprising, it's valuation. It's valuation. The valuation gap between growth and value, despite the 9% or so outperformance of value over Q1 this year, it's still at all-time highs because earnings revisions on value on top of the rest are better than on the growth part of the universe. So you have a combination of factors there that make me think that we have quite a significant period of value outperformance ahead of us.
Yeah, I agree with most of the factors you've mentioned. I mean, I think the bond substitution is an important one as well. It's not something that we professionals think about as much because it's not what we do, but I think it's for retail investors, it's important. Then with the interest rate effect we mentioned, the reality is we've had mega cap tech.
Yep.
They have built monopolies and expanded their cash flows enormously, and they've created enormous value. That's, unless you bought Apple at 10 times or Microsoft at 10 times, you missed that. So that is a factor, that's for sure. That then in turn caused the momentum trade, which for 8 years has worked beautifully. So you just, buy the winners, they go up. So that's another factor. And it's like you said before, these things all kind of are mashed up with each other. You can't point at one alone and say that's the reason.
And I think that makes value investing so difficult, actually. It's, the growth in intangible assets that makes it very difficult to identify what the intrinsic value today is of a company. Because if you look at the FANGs, for example, what is their substance? Can you grab it? Can you see it? No. So that's very difficult to put a valuation on those companies, and I think that makes it also very difficult for those so-called value companies to evaluate them in the right way.
I think the interest rates and the discount rate is all really important, and I think what's happening now is that the growth investors are seeing their stock prices come down, and they can't really quite understand it, and they're at the stage where it's not justified, and they think the market's wrong. I think what's probably going to happen next is the profits are going to disappoint, and that's going to break their hearts, really, and that's what happened in 99, 2000, is that actually tech and everything else cannot grow at 15-20% per annum earnings. It's just not mathematically possible. These companies are too big. We had it when I started my career. Names like Johnson & Johnson, Gillette, Coca-Cola, Procter & Gamble were all very highly valued, and they managed to do it for a number of years, and then they all had to reset one by one and crush the share prices. So I think what's going to really kind of, be the next big thing is that these companies, Microsoft, I know, reported another good number overnight, but at some point it can't. It just cannot keep going that fast. And that's going to lead to a dramatic reappraisal of what these things are all about. So we've got a stage 1 now, which is the PE compression. Stage 2, which we had in 2000. These companies will just compete each other away. There's too much capital going into the space, and they'll compete each other down. And the good thing about the old economy is nobody's building anything anymore in that area. So, it's a sort of classic model of where capital is allocated and returns even out. So I just think that you're going to see a lot of companies that you thought you could rely on. You can't. Facebook is the first of the big ones to go, but I suspect the rest of them are going to follow suit.
Yeah, we're old enough to remember that MySpace was the first social network.
Yeah, I mean, in the UK
Remember?
we had Friends Reunited in the UK, which and I mean, even if you look at the internet providers, you had AOL.
Yes,
These things
yeah,
all,
I know someone who still has a Yahoo account.
Yeah.
yeah, they've all disappeared.
I'm not sure you can compare MySpace to Meta, though. I mean,
Huh?
just look at Meta, how diversified the business is today. It's not just a social media platform. I mean, they invest in enormous businesses today, and I think they own the future. Yes, they are investing a lot. I mean, the metaverse is a good example, 10 billion, but they're making already 3 billions out of a metaverse that only started. So I wouldn't underestimate. I agree with you. Valuations can be high, and the sky's the
I don't
limit.
see what stops kind of 50 people coming in to compete. That's the problem with these intangible businesses. It doesn't take an awful lot to get going. And I'm also not sure that we're having anything anyway of a sort of tech revolution. I mean, I think the mobile phone looks remarkably mature to me. And if you go back through history, the real innovation was things like railroads, electricity,
The telegraph.
automobile. My father says one of the biggest step forward in automation, he worked in manufacturing, was the forklift truck in the 1950s.
When they built the first railway between Zurich and Baden, they were thinking about not allowing women to take it because they would go mad by traveling at a speed of 15 kilometers an hour. But actually, I love companies that don't have a lot of assets. If I think that the cash flows they're generating, which is the part that we value anyway, we care about the cash flows. We'd rather they not have to build an expensive factory. But if we think those cash flows are here forever, wonderful. Then that's what we're valuing. We're just, that's what we get as an investor. We're not going to get we're not going to get the plant. We're going to get the money it produces. And so, if they don't have to tie up a lot of capital, super. The problem, of course, is the barriers to entry and having the competitive advantage lost because other people enter the space. And I think what you say, Jeff, is exactly right. After 10 years, almost none of the market leaders of a particular, take any point in time, and the big names, the most highly valued companies at that point are never the biggest names, the most highly valued, best performers 10 years later. There's very few exceptions to that. One of them is Microsoft. But if you look at the Nifty 50, I mean, Polaroid, Kodak.
yeah.
They completely missed the next.
IBM.
They completely missed innovation. They didn't invest in innovation. If you look at
The best part is Kodak invented digital photography.
Yes, exactly. But
didn't really believe in it.
They didn't believe in it.
I mean,
They sold all
you
the
brought up
patents.
Sony. Sony still is, I would say, a value stock, but it was a turnaround story a couple of years ago when they decided to invest in semiconductors, when they decided to do a digital revolution, became much more involved in digital content. I mean, that is what those companies need to do. If you don't have a digital footprint, even as a value company, an old economy company, I can guarantee you in a couple of years, you're going to be nowhere.
Yeah, but one of my favorite companies is a Swedish manufacturer of big engines. We've been buying some. It's called Wärtsilä. They build motors with bore diameters of 32 to 52 centimeters. Just one cylinder. And you can have 12 or 16 cylinders in one of those motors. So they fill this room. You need those things to power cruise ships and in the future maybe military ships, just anything where you need a 4-stroke engine. That's not going to go away. Right now it's dirt cheap. People aren't paying attention to it. It's not sexy. It's dirty. It stinks. It's going to get cleaner. But, you can't ignore things like that because they're going to be around. We still live in the physical world. We don't spend all of our lives on the iPhone, thank God.
Sure.
Just assuming inflation stays high and interest rates go really up, not what the central banks are doing now. I agree that both stocks will be hammered through the PE contraction. What happens with value stocks?
What happens with?
Value stocks.
They go down less.
Much less. Yeah.
Mechanically, they have to go down less. Just if you do the math, look on our website.
That's a good answer.
No, we give you a framework. We have a framework for looking exactly at that problem.
What's the ratio, just to get a feel?
Sorry?
The ratio. What was the ratio?
The ratio, well, it depends on how much for every 1 percentage point increase in your discount rate, if you're going from, let's say you have a PE of 10, and now you have to go to a PE of 11, so you lose 10%-ish. But if you're going from a PE, if you're at a PE of 20, then what that's at a 5%. You take the earnings yield on that's 5%. Now you go to 6. So you're going from, I don't know that off the top of my head, but you're going from 20 to 15 or 16. Does somebody know that off the top of his head? It's just the percentage change is a lot bigger.
I'm not sure that equities or value equities go down in that scenario anyway. I think equities are an inflation hedge traditionally.
Yeah.
It's property and it's equities. And I'm not sure, I look at the UK and, inflation is about 7%. And interest rates are less than 1. And if I put my money on deposit, I get sort of 50 basis points, which is then taxed at 40%. It's not very attractive. I can buy the FTSE 100 and get a 4% dividend yield just by buying a tracker fund. I'm not convinced that if this gets worse, equities actually
If you
go
look
badly.
at historical data, it always depends at which speed interest rates go up, what the inflation environment. So two dynamics. But if you look, and we looked at global equities, went back 40 years. And if you look at global equities, they do actually very well, surprisingly, in whenever interest rates are in that sweet spot of 4 to 6% interest rates. I'm looking at the US, for example. That's where global equities actually do very well. Again, generalizing this is a risk. There's companies who's going to suffer more than others. You have to do fundamental bottom-up research, be selective about which company sectors you buy, but global equities. Inflation per se is not a bad thing, right? If we think about it, it means the economy is expanding, is growing, right? It depends what component of the inflation is being high. Is this the sticky part, the non-sticky part, etc.? So the devil lies in the detail.
And besides that, besides the two dynamics that Christophe has mentioned, which is the one that the impact of just the mechanical increase in the discount rate weighing on the valuations, offset by the inflation, so earnings go up. You have the third impact, which hopefully will help us very much standing here in front of the room, namely that you've got a rotation into value, which then takes out some of these crazy valuations. So if you say that valuations normalize on some of these companies, so PEs normalize or whatever you're looking at, then you get a positive lift, as people flee out of their Teslas or all the expensive things, and then they buy Wärtsilä and all that boring stuff. Then that should then offset the negative impact of increasing discount rates.
Okay, maybe one last question to wrap it up.
Actually, can I just make one point? Because I think
Sure.
that the fund flows is really interesting. Because if you look at the market cap that's in the big growth stuff, I think I read this morning that Tesla's lost $126 billion of value in the last 3 days or something. You look at Mazda, the car company, which we have in the portfolio, which is a serious and real company. The market cap's $4 billion. So Tesla's just lost 30 Mazdas in about 3 days. It's just unbelievable. So, if a small fraction of that money coming out of Tesla goes into Mazda, then the mathematics is pretty compelling in terms of the effect on the share price.
Does it?
I don't know, but if any of it goes in, saying the market cap is so small.
Yeah, fair enough. There's a huge upside.
Well, there's
a
bunch of professionals in here that we just convinced they should allocate money to value, and so we're going to go out and buy cheap stocks.
Exactly. So for your last marketing pitch for value, I mean, the last 10 years have been a very bad period, but the very long term, I think it's actually one of the factors that work. I mean, it's one of the outperforming factors. So two questions. Why is that? Is it just behavioral errors that investors make all the time? And secondly, what's the outlook for the next 10 years? Is value going to go back to outperforming, or how do you see the longer term future for value?
Well, I would say at least one behavioral error that I think you can exploit when you do value investing is time arbitrage. When you frame a company long run, say, okay, this is worth that much in the long run, and you see short-term factors that do not impact that long-term valuation, distorting the price. There is tremendous money to be made on exploiting those short-term discrepancies. And that error, luckily enough for us, you see repeated over time and in almost any market, probably because there, and luckily enough for us, many and possibly too many short-term plays in the marketplace.
I'm with you on that one, 100%. I think one of the big advantages we have as value investors is time. As long as we can keep a few clients and keep the lights on, keep the lights on, then we're going to make some very nice returns just because of what you said. That is a key competitive advantage that we have.
I think a lot of companies actually, to some extent, flip between growth and value. Anyway, looking at Japan, there's a small number of kind of serial losers and a very small number of serial winners, and most things are actually moving around in the middle. And today's growth companies, tomorrow's value company, etc. And Sony was an example of something that we had a lot of Sony, a lot of Nintendo a few years ago when they were written off, and they've both come roaring back. And I think if you can just stick to the discipline on that, and you can buy reasonable quality names when they're sitting in the doghouse, if you like, then you've got a really good chance of those things reverting back to somewhere where they were. And I think that's one of the things that you can systematically exploit, whilst avoiding the sort of bottom 10% or so that are structural losers, and then we don't go near the structural winners anyway. So value has worked well in Japan. It's outperformed by 2 or 3% per annum for the last 30 odd years, even including the recent period of toughness. So that I think shows mean reversion in action, and shows fear and greed in action. And I think as long as those elements are in the market, yes, value can continue to win.
Herding is not to be underestimated. Humans are social animals. We don't like to be outside of the herd. And so, if you talk about Wärtsilä at a cocktail party, it doesn't get you very far. But if you're talking about Tesla, that's a lot cooler. Yes. And that's not unimportant when in investing.
Good. I think that was a nice way to conclude the panel. I would thank you very much for the audience, and thank you for the panel.